Good afternoon, everyone. Thank you for joining today's presentation. Today we're going to be actually looking at the core functions of what makes up a trader. Thank you. Thank you. And share a bit of information about who we are as a broker and our business. Hopefully this adds a bit of value to what you are doing at the moment, your current stage in the financial markets. And we can break down some concepts pretty simply. Feel free to also grab me at the end for any questions that you might have. Sorry, see. All right, so this is our brand motto. I represent BlackBull Markets. We're a broker based out in New Zealand. We're regulated both by the FMA in New Zealand, the FSA in Seychelles. We're in the cusp of opening up an office in Dubai and acquiring an ESTA license as well. This is our motto. Essentially, we're looking at providing everyday traders with the best possible trading experience. Now, I know that there are several thousands other brokers, and you'll see most of them here, all looking to do the same thing, but we're going to point out where we differentiate ourselves. Part of it is our brand, our aim to be transparent, to provide the best execution possible and access the most amount of instruments across MT4, MT5, TradingView, and CTrader, as well as shared trading platforms. So we offer a multitude of trading platforms. This is a bit about our story. We were founded 10 years ago now. We started in New Zealand. We have offices now in Latin America, Asia, also in Europe, and we're looking to open up here in the Middle East. We now service over 100,000 clients in the world, including partners, and we're one of the fastest growing brokers in the industry. If I just break down what we're going to discuss today, main things are what is value investing. Now, value investing is a very old theory of financial literature made by a gentleman called Benjamin Graham, who will look at some core principles of what his theories were in regards to creating a sound strategy, which were written over 70 years ago, but still have sound or credible application today. Next, we're going to talk about what are good trading habits. Of course, the previous speaker, Raja Banks, spoke a lot about risk management and a lot around about this. It's an actual point, a focal point of building up habits and managing psychology. Psychology in trading makes up for over 80%. Once you can start to master out the psychology for your strategies and when you're at the charts, that's when you really can master your own self as a trader. And then, of course, technicals and your strategy, fundamentals are a secondary thing in my view. Focusing on the alpha is something else we're going to focus on, and then the power of losses. Now, a lot of people probably on this stage won't talk too much about losses. We're going to be brutally honest because in order to experience a winning trade, you have to experience a loss. Losses are a part of the game. We're going to be talking about ways in which successful traders look at managing losses, the reality of human psychology behind losses, when to know when to stop. Also to talk about the taboo topic of when does trading borderline with gambling. And of course, there's a differentiation between the two. However, a lot of people can fall into the habit of having trading and losses taking over their lives, chasing losses. We like to focus on risk management here as a core focus point for managing losses. We're going to get into it. So first things first, Benjamin Graham. He wrote this in 1949. This was the Bible for people like Warren Buffett, Charlie Munger, these big fund investors who have done so well over the last 100 years. All of these principles apply today. We'll run through them briefly, but the first one is investing with a margin of safety. What does that mean? It doesn't mean putting all your eggs in one basket, making sure you have an idea of how much you want to invest in the financial markets from your total pool of assets. That is the first thing to distinguish. For example, if you had $100,000 as your total investment pool, You're looking at FX as a speculative market for trading, and it might present more risk than other forms of investing. So perhaps you want to start with a smaller amount before scaling up, and that is essentially the point of point one. Number two is expect volatility and look at profiting from it. If you come into trading with the angle of expecting volatility, the markets will always remain volatile. There are always opportunities to be had. So again, it leads into the further point of keeping your emotions in check. Now, once you start to differentiate between the actual loss and the number from the emotional point of view, that's when you can really start to see the difference in your trading. What does that mean? Well, what that means is taking your emotion out of the money. It's a very easy thing to say, but a very difficult thing to do in person. If you're losing money, of course, it hurts and you want to try and make it back or find a way to not do it again. So once you start taking losses, if you take your emotions out of those losses by way of using, say, EAs or limit orders, stop losses, etc., that is one way of keeping your emotions in check in trading. Remembering that investing is all about discipline and courage. It is very courageous for each and every one of you to look at stepping into the field of investing or trading. It does take somewhat of a personality to be ambitious, to have financial, personal goals of gain. And it leads on to the further points of trading like a business. Now, a lot of people come into trading and essentially they risk more than they can afford. They trade without a risk management plan. And that goes against of having your financial plan. What does that mean? Well, it means you know exactly how much you're going to risk on a trade. You know how much you're willing to take as a total loss before you quit, and looking at what you're looking to make to the upside. So that all can be modeled in a financial plan. If you treat your trading, your personal trading, as a business, that's when you can also start to see more organized success. Run your own marathon. This is a point that's pretty important to me because at the moment we have thousands of social influencers and everyone posts about making millions and millions of dollars of profit. And of course, that's very attractive. You have these beautiful cars outside. These are all here to entice you, your psychology, like, I want this. But the idea is you've got to respect where you are in life and what you want to achieve and what is realistic in terms of achieving things. Of course, the world is your oyster. There's unlimited upside, but the idea is building a sound financial plan to look at steady growth. Keep in mind, the best hedge funds in the world that manage billions and billions of dollars only make between 6 to 10% a year. So that's less than 1% a month. If you're doing more than 1% a month, you're beating the best funds in the world. Of course, interest rates are pretty high at the moment. Market volatility is unprecedented with persistent inflation, higher US dollar, expected higher rates in the Fed. You'll always have changing economic climate, but the important thing is to run your own race and understand where you are in your financial stage. Don't overtrade. It's something that the previous speaker talked about as well. It's a simple concept. It's about thinking of how many trades you want to place in a day, in a week, etc., and sticking to that. Going on quickly, you are your owner of your own trading, embracing price fluctuation and understanding your costs. That comes in choosing your broker wisely, making sure that you have the best conditions possible. It is a free market. You can go to whichever, shop around, look at which has the best conditions because your costs make up a huge proportion of your total end profitability. If we just go to the next slide here. Okay, so how do we form good trader habits? Now, this is a very personal thing, but I'm just going to outline key aspects to what I believe is a good trader habit. Now, the reality is, if you would follow recent FCA regulatory guidelines, a lot of brokers now have to put in the disclaimer, how many traders lose money with that broker? What does that mean for you? Well, I mean, it gives you an idea of the harsh reality of trading. You're entering a risky game more than 80% of traders are likely to lose money in their first year of trading. That gives you a bad, negative experience. It may not make you want to come back again. It may make you want to give up. However, the idea is to understand, how do we get on the side of the winners? How do we become profitable? And how do we form a good strategy? That is by making good habits. So we'll get into this briefly. Sticking to a simple strategy. Now, my main thesis on trading is keeping your charts extremely clean, not to overcomplicate things, not to essentially confuse yourself. That's the first starting point. The second one, which is the golden rule, which is use a stop loss on every single trade. Your stop loss is your best friend in trading. What does that mean? That means that for every trade you make, you have a fixed amount you want to risk. You know exactly how much you're willing to risk on every trade. This will form your risk management plan, which we'll get into in the next slide. Consistent risk to reward ratio. We'll get into the maths on the next slide, but just as a basic example, if you're risking $1 to make $2, that's a 2-to-1 risk to reward ratio. If you have 5 trades a week with the 2-to-1 risk to reward ratio, all you need to do is be successful 2 out of the 5 times. So say, for example, on Monday to Friday, you lose your trade on Monday, Tuesday, Wednesday, you're down $3. You hit your take profit on your Thursday and your Friday, you're up $4 there. So 4 minus 3 equals a positive $1. What does that mean? You've made a positive gain on the week. It's about understanding those probabilities. Once you can understand those probabilities, you can start to scale up. That's the power of having risk to reward on every single trade you place. What that means is you've capped your downside risk and you're having a consistent margin of return if you are on the right side of the markets more than the wrong side. So putting probabilities in your favor is one of the most important things in building a good trader habit. Not over trading is another one. So what does that mean? That means, when we discussed earlier, getting from trading to gambling. Where does your risk level sit? You want to have an idea of how many trades you want to place in a week, in a month, and stick to that. That is the essential rules of becoming successful in the markets. And all of this helps you to take your emotions out of the market as well. Patience, persistence, and being able to learn through your mistakes. What does that mean? Well, it means that you're not going to get rich overnight. Once you start understanding that, then you can start building good trader habits. Like I said, if you're even making over 1% a month, you're in the top 10% of traders' funds globally. If you can start looking at the long term and achieving 12 to 15% annually, that is where trading becomes habitually positive. And if you do that over the course of many years, that's when you can start building some sound track records. That's where patience and persistence comes in, knowing that this is a long-term game. This is not something that's going to change the whole dynamics of your financial landscape within a couple of months. The notion of detaching yourself from money, that's another thing. And how do you do that? You focus on the alpha. How do you focus on the alpha? We'll get to the next slide. By using risk to reward. So going through that example that I had previously, that I spoke about with 5 trades a week, you just focus on this key principle of risk to reward. This is an example of a euro-dollar trade where we're risking 1% on a $20,000 account. So the way we work this out very simply is you take your account balance and you take 1% of your account balance. In this case, you've got a $20,000 account. 1% of that is $200. What that means is you have to put your stop loss at the value of $200. For example, you could trade 1 lot with a 20 pip stop loss, or you can trade 0.1 with a 200 pip stop loss. That will give you your $200 risk. Inversely, you would set a take profit if you're going to enter this market and go long with 40 pips to the upside if it's one lot, or 400 pips if it's 0.1. So essentially with this, we're looking to make $400 and risking $200. That's your 2-to-1 risk to reward ratio. And if you start to do the maths, if you're hitting take profit even twice out of those 5 trades, you're profitable over those course of those 5 trades. That is the power of risk to reward. That is how big funds manage their money profitably, over the long term. So we're just going to break down now the losses. Now, losses is again another taboo subject. Of course, people in the financial markets online want to make you, don't necessarily all the time break down the harsh realities of trading. The first thing you have to acknowledge is that trading is a huge risk. It's extremely speculative. When you're trading with leveraged products, that magnifies that risk, especially in a world where brokers offer you 1,000 to 1 with 100% deposit bonuses, cash bonuses, trips around the world. They want you to lose your money. That's the harsh reality of everyone in this room. It's a natural conflict of interest. How do you break down that as a trader? There's nothing you can do about that industry complex, but what you can do is on a personal level, look at how you can manage your losses. Now, how do you do that? The first thing I like to personally do is have a journal. You can have an Excel sheet, for example, and write down every single time I make a loss. Especially if you've just started trading, it's a very powerful tool to have, because essentially you're putting down on paper how many times you've made a loss, and over time you'll start to understand why you're hitting a loss each and every time. It could be you're not using a stop loss, you're over risking, etc. Once you start to identify why you're losing money, we can start looking at addressing those topics. Again, gambling, trading, asking yourself, am I gambling or am I trading? Am I trading for the right reasons or the wrong reasons? Knowing when to stop. We all the time suggest for traders to just delete your trading application and take a break. Now, of course, it's up to the person whether they want to listen to that, because it's always quite inviting to go to somewhere else and trade, but at the end of the day, we're all humans. The emotions behind trading are extremely strong, especially when you're riding high. Taking a break is extremely healthy, especially if you've had a bad experience at the beginning and you've lost a bit of money. Take a break for however long it takes you to get grounded. Practice on a demo account. Build your strategy again. Start researching different types of markets and empowering yourself with knowledge. Then come back into the market with a sound financial plan. That's essentially one of the greatest tools that you can have as a trader. Also, are you subconsciously playing to lose? Now, this is something that a lot of psychological studies talk about when they deal with addiction to, say, gambling, or addiction to people going into casinos. Some people have the natural thrill of being able to feel a loss. Some people just essentially like to play to lose. And subconsciously, you have to ask yourself, am I doing that? Why am I doing this? What can I do to address that? So it's really understanding if trading is right for you or not. And that's also a key question at the beginning of when you're entering your journey, or even if you're in the middle of your journey. Next one, trading to the edge. So when you're losing money, there's a common theme of chasing losses. It's a natural human concept. You want to make back the money you've lost. How do you do that? Well, you might start over trading, or you might start hedging an open trade, which has gone against you, and then you start paying swaps on both sides and you're screwed. So the idea is to understand where is the edge, and that edge might just mean closing out your positions, starting again, and focusing on reducing your risk right down. Again, the last one is about seeking support. It's important to have a support network around you. You're not in this together. This is the power of an expo like this, where you can meet fellow traders, you can talk to people with experience, and you can understand what am I doing wrong? How can I get better at this? And also look at learning key principles about profitable strategies and moving forward positively. So that's it from me. That's my presentation. Feel free to grab me at booth 12 with BlackBull Markets. I'm happy to speak to any one of you, and I really appreciate your time. Thank you so much. Thank you.